So a lot of financial advisors and life insurance agents get wooed by these gimmicky, super high-risk interest accrual premium financing programs, where the client doesn't pay the full interest payments, and they accrue the majority of the interest payments by rolling those amounts back into the principal loan balance. Now, in these programs, they cross their fingers and hope the policy stays in force, so the death benefit can pay off the loan. These programs are essentially marketing semi-free insurance, which is insanely high risk for the client. And all the while, the premium financing loan debt is compounding, driving the policy deeper and deeper underwater relative to the premium financing loan balance. And if they try to pay off the loan with the policy cash value, it puts the policy at high risk of lapsing. And in our opinion, this is putting the client in a terrible situation. I mean, there's no free lunch in the world of life insurance, even though that's what some of these interest accrual programs would have you believe. Now, these ridiculous gimmicks may sound good on the surface, but there are tons of premium finance life insurance policies out there that are absolutely going to blow up, largely due to these ridiculous interest accrual programs. Lionsmark Capital was one of the featured speakers at FFR's Spring Symposium at the Montage Resort in Laguna Beach, and we exposed the smoke and mirrors tricks of interest accrual. And we've seen several different premium financing firms that lead with the free or virtually free life insurance pitch. This client was recently pitched an interest accrual premium financing program. Now, the client was told that they would borrow $721,000 per year for 10 years, totaling $7.2 million. They would then pay about $86,000 per year in mystery payments, which is supposedly a combination of some interest plus these variable nebulous fees. But that's not what the actual interest payments would be. As you see here, the interest payments are speculated to grow north of $400,000 per year by the 13th year. Now, in this goofy model, they wouldn't pay these actual interest payments. Rather, they're being encouraged to accrue the large majority of the interest and roll it back into the principal loan balance. Now, as you see here, they've only borrowed $7.2 million, but now they're $9.4 million in debt because of the accrued debt continues to compound every year. And to make this proposal even more absurd, the accrued interest assumes that the borrowing interest rates are only increasing at an annual growth rate of 3 basis points. And to put that in perspective, it would take over 33 years for the borrowing rate to increase from 4% to 5%. But this is absolutely ludicrous. You see, anyone can manipulate numbers on a spreadsheet to make the interest accrual premium financing look good, but it has nothing to do with reality, and in our opinion, this is very misleading to the client. Now, as you see here, the illustration shows a gross policy cash value of $10.4 million, and it shows a $9.4 million loan payoff in the 14th year. Now, $10.4 million in cash value minus the $9.4 million in loan payoff ought to be $1 million left over, yet the illustration shows a $1.3 million cash surrender value. I mean, does that mean that the cash value got a net 30% return in that year? I mean, how is that even possible? Well, in addition, the proposal shows the client drawing out an annual income in the amount of $319,000 each year for the next 31 years. Now, it doesn't take a rocket scientist to figure out that if there's only $1.3 million in cash value, the client can't pull out over $300,000 per year for the next 31 years in a row. Well, here's the dirty little trick they're using. They're using participating loans, where the policy crediting rate is always getting a positive arbitrage over the policy loan rate, which in our opinion is leading a client to believe something that may or may not ever happen, which is extremely misleading. So in order to show an apples-to-apples comparison, we recreated this one-year-old policy to show what it would look like today. However, a year ago, this particular policy's AG49 max rate was 6.17%. But this year, the AG49 maximum illustrated rate is only 5.76%. And wait until you see what happened when we tried to illustrate the exact same design this year at 5.76%. Okay, same $721,000 in annual premium on a 10-pay. And again, this is the exact same product from the same life insurance carrier with the exact same target premium. We assumed the same unrealistic borrowing rate, only increasing at 3 basis points per year, which is a crime to show in our opinion. with the accrued loan balance only growing to $9.4 million. And when we tried to pay off the loan with a participating policy loan rate of only 4.65% nonetheless, the policy lapses in the 14th year. I mean, ay. We would obviously never recommend this to a client, but apparently several of our competitors show this interest accrual premium financing program all the time. So after we showed the client the truth about this interest accrual model, we transparently and objectively showed them 3 better options. Non-finance GUL, first dollar premium financing, where the client borrows all the premium and posts outside collateral, and leveraged index arbitrage, our proprietary program where the client pays the first year premium out of pocket and then finances the remaining premium. Again, this program doesn't require the client to post any outside collateral or sign any personal guarantees. So here were the results. GUL costs almost twice as much as the 2 financing options. And for the 2 financing options, both of which Lionsmark Capital can facilitate, the total outlay was comparable. But look at the difference in cash surrender value over a 40-year period. $5.4 million versus $7.6 million in the leveraged index arbitrage program. That's more than 3 times greater cash value in the leveraged index arbitrage program. And the death benefit significantly more as well. And look at the difference in net IRR when it comes to cash value accumulation. 1.61% versus 4.89%. Now, despite the numbers being substantially more favorable in our leveraged index arbitrage program, we can absolutely do the traditional first dollar financing as well, where the client borrows all the premium, although they would have to post outside collateral and sign a personal guarantee. But again, if they want to borrow all the premiums, we can definitely facilitate this program as well. But the first dollar financing policy is scheduled to lapse at age 100, whereas the leveraged index arbitrage program lasts until age 121 and then it endows. Now, ultimately, the choice is up to the client in terms of which program they like the most. For example, perhaps the client was thinking about funding the first year premium by doing a capital asset transfer from their managed investment account, but some of the equities in their portfolio contained unrealized gains. In this situation, it may make sense for them to borrow the first year premium and post the managed account as collateral so they don't get hit with the immediate long-term capital gains tax. In this decision is a decision that we can mathematically help them calculate so they make the most prudent mathematical decision. At Lionsmark Capital, we always say the math doesn't lie, and we're the only premium financing intermediary that can show you the true math. So if you're a financial advisor or a life insurance agent, or you manage a family office, and you're thinking about talking to your client about premium financing, have Lionsmark Capital design the program properly, because you want to sleep well at night, knowing that your client is being afforded a superior premium financing program. Because if you don't work with Lionsmark Capital, sure, you might sell a big premium financing case and beat your chest now, but if it isn't done properly, it could all come crashing down on you. For more information about what our proprietary software modeling capabilities are, contact us at lionsmarkcapital.com for a private consultation with one of our managing partners. Lionsmark Capital, a better way to finance life insurance premiums.